On the surface, retirement planning hasn't changed all that much over the years. You work, you save, and then you retire. But while the mechanics may be the same, today's savers are facing some challenges that previous generations didn't have to worry about. First of all, life expectancy is longer, which means you'll need your money to last longer, potentially into your 90s. Bond yields are also much lower than they used to be, which means you can't buy a few fixed income instruments and earn a double-digit return. Then there is the health crisis due to the coronavirus pandemic. So in this video, we are going to discuss what will happen to your retirement in the upcoming year. Let us know your opinion in the comments section below. Now before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. It's a scary time for new retirees. Stocks have plunged this year. Bonds, which traditionally serve as a ballast when stocks falter, have also been pummeled. Both trends are worrisome for seniors who rely on investments for their retirement income. High inflation also means retirees need to draw more income to afford the same items and make ends meet. However, there are steps retirees, and those planning to retire soon, can take to protect their nest egg. So, how can you have the retirement you've always wanted? After all, retirees want to experience all the things they couldn't do when they were too busy working. Exotic travel vacations, marathon running, novel writing, spending more time with friends and family, the possibilities are almost endless. There are several steps, which we explain in this retirement guide, from budgeting and setting goals to choosing the right retirement savings account that will help you map out a plan that's right for you. This is compounded by the fact that more companies are moving away from defined benefit pensions, which guaranteed you a certain amount of money in your golden years, to defined contribution plans, which are more subject to market ups and downs. As you can see, inflation-adjusted average returns for the S&P 500 have been between 5% and 8% over a few selected 30-year periods. The bottom line is that using a rate of return of 6% or 7% is a good bet for your retirement planning. Firstly, it's important to note that retirement planning should be a long-term process, rather than something that can be predicted on a yearly basis. Your retirement plan should take into account factors such as your current age, expected retirement age, desired lifestyle in retirement, current savings and investments, and expected future income and expenses. That being said, there are some factors that could potentially affect retirement planning in the upcoming year. These include changes to government policies or regulations related to retirement savings and Social Security benefits, fluctuations in the stock market and other investments, and changes in personal circumstances such as health, employment status, or family situations. To ensure a successful retirement plan, it's important to regularly review and adjust your strategy as needed. This may involve consulting with a financial advisor, staying informed about changes in the market and policies, and regularly evaluating your savings and investments. Some general tips for retirement planning include starting to save as early as possible, diversifying your investments, minimizing debt, and considering additional sources of income, such as rental properties or part-time work in retirement. By taking a proactive approach to retirement planning and making adjustments as needed, you can help ensure a comfortable and secure retirement. Why it matters. The S&P 500 index is down nearly 17% in 2022. The index fell into a bear market at one point Friday before recovering a bit. The Bloomberg U.S. Aggregate Bond Index is also down over 9% this year. Bond prices move opposite interest rates, a dynamic that has stressed bond funds as the Federal Reserve raises its benchmark rate. Investors are most vulnerable to market shocks in the early months and years of retirement. This is due to sequence of returns risk. Someone who withdraws money early in retirement from a portfolio that's declining in value is at greater risk of depleting their nest egg too soon relative to a retiree who suffers a market downturn years later. When the market pulls back, it means investors need to sell more of their investments to generate income. That depletes savings faster and leaves less of a growth runway when things rebound, hobbling a portfolio intended to last several decades. The sequence, or timing, of the investment returns is what's important. Consider this example from Charles Schwab of two new retirees with $1 million portfolios and $50,000 annual withdrawals. The only difference is when each experiences a 15% portfolio loss. One has a 15% decline in the first 2 years of retirement and a 6% gain each year thereafter. The other has a 6% annual gain for the first 9 years, a negative 15% return in years 10 and 11, and a 6% annual gain thereafter. The first investor would run out of money after 18 years, while the other would have about $400,000 left. If you're planning for 30 years of retirement, those first few years could be really important in terms of what you end up experiencing for your outcome, Blanchett said. Of course, some retirees are more vulnerable than others. For example, a retiree who gets all or most income from Social Security, pensions, or annuities is largely unaffected by what's happening in the stock market. The amount of those funds is guaranteed. Also, sequence of returns risk is likely less consequential for someone who retires at an older age because their portfolio won't need to last as long. Nor is it likely to greatly affect a retiree who has saved far more money than needed to fund their lifestyle. What to do? If new retirees are nervous given the current market situation, there are a few ways they can reduce their risk. For one, they can pull back on spending, thereby reducing withdrawals from their nest egg. An adherent of the 4% rule strategy might opt to forego an inflation adjustment, for example, though there are many different schools of thought relative to spending in retirement. Whatever the strategy, reducing withdrawals puts less stress on the investment portfolio. Does it mean you can't take a fun cruise or vacation? Not necessarily, Blanchett said. It requires thinking more about trade-offs, potentially based on how things go. Similarly, retirees can restructure where their withdrawals come from. For example, to avoid pulling money from stocks or bonds, categories that are in the red this year, retirees can pull from cash instead. This gets back to sequence risk and trying not to pull money from assets that are down in value. Drawing from a cash bucket while waiting for other assets to, hopefully, recover helps achieve that. Retirees may not have several months or years of cash handy, though. In this case, they can pull from areas that haven't been hit as hard as others. For example, perhaps from short or intermediate-term bond funds, which are less sensitive to rising interest rates. Workers who haven't yet retired and who are worried about having enough money to do so can opt to work a bit longer to the extent they're able. Or they can think about earning some side income once retired to put less pressure on their nest egg. Reducing demands on your investment portfolio is one of the most important things you can do, Ben said. For example, Social Security recipients get a guaranteed 8% annual boost to their benefits each year they delay claiming past full retirement age. That 8% boost stops after age 70, though. Seniors who can delay get a permanent bump in their guaranteed annual income. Today's retirement and pension plans were not designed for the current reality of people living longer, healthier lives. The traditional three-stage life of school, work, and retirement no longer functions in an age of unprecedented longevity and shifts in work and health outcomes. Many people will want to work past mandatory retirement age because they will live for another 20 to 30 years, while others will need to work longer to remain financially resilient in later life. As societies continue to age, with many women living longer than men, new ways to deal with the retirement savings gap will have to be created to address gender and racial disparities, the changing needs of older workers, as well as the growing number of gig workers. How much do you need to save for retirement? One of the hardest parts about preparing for retirement is thinking about life as a 70-something. A lot of people get so overwhelmed about saving for an unknown future that they end up not saving anything at all. Thankfully, planning for retirement is not overly onerous, but you will need a roadmap, one that can evolve over time, to keep you on track. Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.